Hello and welcome to another of our series of interviews on our platform, Citiesabc.com. We're here to speak to thought leaders, entrepreneurs, and technologists at the forefront of developments in 4IR technology revolution. Today, I'm joined by Kiernan, founder and CEO of DAG Global, which provides banking services and solutions for fintechs, SMEs, and digital asset businesses and facilitate their entry into the emerging disintermediated blockchain and AI economy for existing regulated financial firms. With me is Hirander Misra of GMEX.com, Chair and CEO of GMEX Group and SECDEX. Hirander is a Chairman and CEO of also GMEX Group, offering innovative solutions for the creation and operation of electronic exchanges and post-trade infrastructure in securities, FX, derivatives, commodities, crypto and digital token assets. GMEX is one of the top 10 leaders in blockchain technology in the all-party parliamentary committee group that was set up in 2018 report on the UK blockchain industry, where Hirander is one of the key influences in that development. So welcome, Sean. Could you briefly introduce yourself and tell us about your fintech banking and regulatory journey over the last few years?
Well, and thank you very much, Hilton, for having me. I've got a banking background. My whole career largely has been in financial services. Most recently, I've been with the first bank in the world previously to engage with crypto, which was a Swiss bank, and I was the London COO. And prior to that, I had been in a division of Credit Suisse, where I've moved to the UK in 2010 to build the bank. And what we're doing now at DAG is building another bank, which is, we hope, the first in the UK to be crypto friendly, to engage with the new emerging digital asset sector, afford them a banking experience which is positive, like which they have in other countries like the US and Switzerland, but here in the UK.
Brilliant, thank you. And Hirander, welcome. Can you also highlight your personal fintech, banking and technology journey today?
Yeah, hi Hilton, hi Sean. Pleasure to be on this Citiesabc interview. My background's 24 years in electronic trading and exchanges, and most notably on the equity side, where I co-founded a platform called Chi-X Europe. And then with GMEX, over an 8-year journey subsequent to that, we've been heavily involved in the market infrastructure space, but equally heavily involved in the digital capital market space, and also supply chain on agri and gold for the last 4 years. And we see phenomenal opportunity, which I guess the current crisis that we're in will actually expand upon rather than reduce as we move forward.
Thank you. In terms of your mission and vision, Sean, of course, the fourth industrial revolution is upon us. And could you just outline what benefits are there to both the B2B customers and the B2C customers in actually utilizing the concept of a digitally enabled bank?
Yeah, and I think Hirander's touched on one of the main issues of our current age, which is COVID-19 and how that's impacting my sector. We've seen, particularly in the SME space, where we intend to lend towards a real gap in the servicing of SME lending, which is something the economy has got a strong need for today. There's been some interesting reports coming out from the likes of Finch VC, which are mentioning that SME lending platforms are seeing a huge increase of interest, and likely off the back of the current challenge, when the economy starts to reboot, we'll see a resurgence of demand as businesses start to engage with financial services in a more active way. I think the fourth industrial revolution is something that seems to be an inevitable trend as the technologies are coming online, that players will need to be engaging actively to understand, particularly the data that's going to be available at scale in a way that's never been available before, how that data can be used, in my space for financial services, to create intelligent decisions and intelligent relationships. And we're firmly of the view that we'll still need people to intermediate those relationships, but we think the back end will change materially.
Thank you. And in your case, Hirander, in terms of the fourth industrial revolution, you've traveled extensively and have business interests globally. Of course, you're working on a B2B basis, but what sort of impact are you seeing on a B2C basis in terms of the fourth industrial revolution as a digital bank?
Yeah, I mean, both B2B and B2C are interesting areas. So if we look at now, recently, an article that was also covered in HedgeThink that I wrote about the impact of COVID-19 on fintech. Now, I would contend there's a number of hot areas here. You know, people talked about, you know, some of the digital banks suffering, but actually I see this as an opportunity for them because, you know, Sean, I'm sure will expand upon, they've got much lower cost to income ratios than the larger established banks. But equally, you know, following an article that I recently wrote talked about the dearth of finance for SMEs. And this is not only a developed country problem, it's an emerging market problem as well. And whether it's the banking sector or whether it's the exchange sector, the models aren't terribly suitable for SME development. And the current crisis with a constraint on capital will only exacerbate that issue. So when we talk about the fourth industrial revolution, there's a number of key areas, payments and the various offshoots of payments and digital, you know, whether it's wallet-based or digital banking, I see as a real opportunity and an expanding area post-crisis as bricks and mortar businesses struggle to service their customers. And certainly, I think the future is bright on B2C and B2B payments. There's a number of African economies that have contacted us at GMEX over the last month, is talking about accelerate the move to digital now, and also how they can accelerate the move to digital in the sense of not only payments, but also digital currencies and reducing the systemic dependency on the financial system. Now that creates an opportunity for financial inclusion as well, because if we look at the current crisis, there's a big strain on individuals, and the access to finance, given incomes are drying up, is also acute. Now, if we look at financial inclusion, and also whether it's then charitable donations, but also how they can translate into opportunities, i.e. teach them how to fish rather than fish for them. The fourth industrial revolution presents an opportunity there, and exchanges finally have to reinvent themselves as well to service that model because they contend that the current model is broken.
No, I totally agree with what you're saying. The thing is that the fourth industrial revolution is now. We're in the middle of it. It's the nascent growth of that. The use of technology, particularly now, is very, very important. The outreach into the regions of the world and the customers of the world in order to bring them into the global economy is there today. We've got the technology, but one of the biggest boundaries and barriers that we find to that is regulatory. The regulators are standing there with their eyes wide open like rabbits in front of headlights going, oh my God, what do we do next? In terms of disintermediated banking services, both to businesses on the supply chain and also to the underbanked or even the unbanked, there's a massive knowledge gap. There's a trust gap. There's some competition. They've put sandboxes together in terms of trying to understand this, the regulators. There's issues to do with data protection and GDPR in the UK. There are big platforms like Facebook and Google, which are, well, more Facebook and others, that are essentially using data in ethical and unethical bases. What do you see, Sean, in terms of your experience working with regulators and their willingness to adopt the fourth industrial revolution going forward?
I think it's a very interesting question. I think there's various ways to certain in different places than others, and I'll speak from the UK perspective, which is my own current background. I think the sandbox environment that you speak of is quite a helpful way for regulators just to engage with the private sector, but also to understand firsthand what are some of the stresses that the private sector are facing to implement the fourth industrial revolution. There's now an international sandbox framework where they're working with each other. And what I picked up particularly in the case of, say, Facebook and the Libra project is that every regulator is aware of this and is very au fait with the language now used. And in the UK, there's, say, the Crypto Asset Task Force, where they come up with their classifications and frameworks to help the private sector understand. And this is particularly regarding the blockchain technologies. I think AI has a similar framework as well, with the different Hirander, and GMEX is one of the top 10 in the blockchain APPG. But there's a similar APPG for AI. So there are ways for engagement, but I think the underlying questions are often about governance and how can the new technologies be managed in a way that provides access rather than restricts, say, data confidentiality. You mentioned GDPR, or restricts the freedom for people to control their own or how to face with things. Sometimes regulations interpreted, and I think GDPR is a great example, sometimes prevents innovation at the same time as providing rails for innovation. And often the costs to implement GDPR, and we're going through this now as a startup, where we have to flag every single file in our accounts with the retention period, because we need to meet the various categories for data retention. For a startup, that cost is huge, just in terms of our time and aggregating that data. But it's something that if we do it properly now, future-proofs us, we can then comply with regulation. I think a lot of firms at every stage of their life cycle are having to do this. And in a way, there's a cost that then is imposed on us, and it tends to be something that the bigger companies can bear more readily because they can afford the frictions. If in the end I would prefer to pay those extra costs, I think thus far yes, because we see often abuses of regulation, the consequences of that. If things aren't thought through properly, and we end up with, say, a company that has access to too many powers that it shouldn't, and I'm not going to mention another name, but I'll think of a few. Or you see countries which are then taking access to data. And again, I'm going to say COVID-19 and the way that's played out in different nation states. There are some things which are quite scary, and I'd rather there be that process of dialogue to come to an appropriate outcome. Let's say more of a 94 type.
Yeah. Thank you for that. I mean, in terms of your experience, Hirander, you have obviously from the technology side of that equation, in terms of naturally you'll be gathering data through the processing of the pass-through of transactions through your platforms, and the dealing of course, GDPR is very much a European initiative which has far-reaching impacts on the principles in other countries. But how are you actually dealing with that if it's non-UK, and in terms of using people's data in an ethical way, even though the regulation stops you, doesn't preclude you from doing that, but essentially you yourself make the decision yourself to actually be responsible with that data?
Yeah, absolutely. And operating in multiple jurisdictions, different jurisdictions have different policies around this. But the key is, putting together the right policy, being transparent around it, and being transparent on what you're using and how you're using it. And we're very much proponents of that. But there's also a bigger issue here to solve, and that kind of touches upon a few of the points that Sean made, because our data is being used day in, day out, whether it's the supermarkets that take our data, and then hedge funds are paying a lot of money to buy it because they then can look at how companies will be potentially trading and predict on the basis of what consumers are buying. But when we're kind of providing our data and it's being utilized, there's no transparency back to us. So I think what we're really going to see as part of the fourth industrial revolution is democratization of data. And we're not far away from our data being used, but us being paid every time it is being utilized, because ultimately it's our data. Then we've spoken about personal data exchanges and the like, but we're not very, very far away from that. And the technology now exists to facilitate that. Now, touching upon another point that Sean raises with the likes of Libra, yes, effectively, with the last crisis, we saw Bitcoin emerge post 2008, and there's different views on how digital assets can be utilized going forward as a store of value, and how there's an alternative choice that's needed, so that the current financial system and the new wave can coexist, or we create a combination of the two. But this raises a problem about regulation, because it's not consistent across the globe, as Sean also points out. And also we're seeing the wild west of crypto and some level of regulatory arbitrage there, and people calling themselves exchanges or banks, or carrying out activity like that, but having no regulation to do it. And to me, things like ICOs were game-changing because of the network effect. STOs are, but misuse of them creates mistrust amongst those very investors, whether they're retail or institutional, that these types of products would attract. So I think regulation is there. It needs to be pragmatic. Of course, push the boundaries and look at the opportunity, but really it's needed, because what happens if it goes wrong? But also, some of these initiatives are naive, because there's no such thing as a global bank, or there's no such thing as a global exchange. You can create a construct, but you've got to go and get regulated in every single jurisdiction and then interconnect them. Now, blockchain allows us to interconnect those nodes and create asset swaps and other activity across those nodes, but you still can't get away from the fact that across those nodes, in those individual nodes, you have to be regulated. So we see regulation as important, but we also see our feedback to the regulator as important, because recently Sean and I, with our respective companies, contributed to the guidance note and the consultation that came out from the UK FCA on digital assets, and we're named in that with about 79 other companies. Now, we see this as an opportunity to change the way that we're regulated, because the UK we do see as a very attractive jurisdiction, and we'll touch upon how a bit later in this. But we also see gaps in policy that we think, if addressed, could create a massive hub in the UK for digital assets. But that could also then align with offshore opportunities, such as those that we're looking at in the Seychelles, and you're looking at in Gibraltar as well, for example.
I mean, indeed, from the perspective, from a regulatory perspective, of course, you can't have a global regulator. But in terms of the communication of what you're doing, the technology that we have at the end of the day is able to transparently give that information to anybody that requires that information from a regulatory perspective.
Yes. And you're seeing that because the FCA put together a program where there's multiple countries running sandboxes, all working together now and creating a bridge of collaboration, because whilst jurisdiction may be regulated by a different regulator with global standards, whether it's the work that the OECD are doing, and there's different views on that, of course, and the G20, there's got to be a consistent level of regulation, because otherwise you will see regulatory arbitrage. And what we want is ultimately consumer protection and investor protection, so that these platforms can be utilized with a level of trust, and that then is at a transaction level, but also then the data from it as you've explained as well.
Exactly. I mean, that leads us into a quite important area, security, in terms of if you look at most of the regulation at the end of the day, it's to do with KYC and anti-money laundering, et cetera, et cetera. So from your side, Sean, in terms of the different technology layers that you put in place in building out your bank, digital bank, what sort of additional layers are you putting in to deal with security?
It's something we spend a lot of time on, and obviously with the client base being more the digital asset or cryptos, it's something that's very hot a topic for the regulators as they engage. We've, in my own background and having looked into this within a regulated environment, which is Switzerland, we've come full circle almost in that being on the public blockchains, at least, not the private blockchains, I'll put them to the side, data can be much more transparent than it has been on the traditional rails, on the fiat payment rails, where you only see necessarily the private source of funds if someone discloses to you, or you see the prior counterparty. You can't see the life cycle of that money because that individual, say, dollar bill only has a life from the point at which you've received it. So money laundering, for example, is harder to trace. Whereas on the blockchain, you not just see the previous however many transactions there have been, but you see the whole ecosystem of with whom else those individuals have been trading. That is an emerging field, and there's ways to use that, if you will, by having, say, off settlement or counterparties engaging where they use some of the more nuanced expressions of this technology, and Bitcoin Lightning is one that we're watching very closely. In a way, if we can layer that on top of the traditional techniques for AML and KYC, we're going to do enhanced due diligence on every client we onboard by nature of the clients we're engaging with. We think that digital assets, at least in the blockchain-based frameworks for moving and storing value, probably give actors like us a leg up versus, say, traditional banks, which only are looking at one piece of the puzzle.
That's very, very interesting. I mean, in terms of the development of the products that you are putting in place, having got the regulatory piece right, the KYC piece right, and the AML piece right, in terms of the products, another issue that most people are concerned about in terms of custody, trading, use of different exchanges, how does your platform deal with the custody and the trading and the exchanges?
Right. So our focus really is the fiat banking side. We see a strong gap. There's some strong names in the US, like Silvergate or Signature in New York, or in Switzerland, SEBA and Signum. In the UK, there's as of yet no fit-for-purpose bank to engage in the space, just to provide fiat rails. But we also do intend to service the crypto side of customer needs. In order to do this, our intention is to engage with a sub-custodian with a big name. And Fidelity, for example, has a digital asset custody play. And we use them then as a cold storage provider to hold the funds. There's implicit insurance because of the name. And there's a few other blue chip names and very good companies now offering custody services. And just as in traditional finance, if you hold an asset, often there's a sub-custodian, even if the client doesn't know about it, to provide that risk mitigation. And for any trading we're looking to do, there's as yet not really a prime broker in the crypto space. We're keeping our ears to the ground. As soon as there is one, we'll knock on their door. But there are also some good names that could at least act as a principal counterparty for us not to then take that risk on our balance sheet.
Hirander, on your side, I mean, you've got anything to add to that?
Yeah, no, it raises an interesting couple of issues, because if we look at the existing constructs, the traditional finance and brokerage, but there's also, you know, a number of intermediaries along that chain, and it's very much from a trading, exchange matching, clearing, settlement standpoint, vertical silo after vertical silo, and they're interconnected by lots and lots of intermediaries. So now with blockchain technology and that's fine. Private networks into public networks, for deposits and withdrawals of cryptos as well. You can interconnect those different nodes with far fewer intermediaries. But what we've seen with the current crypto exchange or digital exchange model is everyone's really creating the same silos that have existed since markets went electronic in the 1990s. We haven't had that fundamental change like the internet spawned, for example, that was very, very disruptive but beneficial for the market to grow. Now, I would contend, having spent over 2 decades in the exchange space, that we're going to see that game-changing aspect of this really play out in an accelerated fashion over the next few years. Now, what does that mean? It means from a custody perspective at the moment, if you want to deposit into a digital exchange and withdraw, as Sean will know, because he trades actively across a number of them, it's an absolute nightmare. But what will happen now is those nodes with many markets and many custodians will interconnect. We, for example, have developed middleware that facilitates that. And we tested that out with Sean on a collaboration with IBM blockchain in Q4, well, at the end of September into October last year. Now, initiatives like that will allow markets to interconnect, and it will become much more wider than that, which means that actually rehypothecation of assets is very, very important, because even you and I as individuals will hold assets in different banks, whether it's funds or in different locations. And the ability now with blockchain and digital assets to harness the movement of those assets between different locations becomes a massive opportunity that will revolutionize finance.
Thank you for that. Sean, from your perspective in terms of technology, I mean, there's lots of technology out there that people are producing different platforms. Every day you open up your mobile and your news feeds, there's somebody coming up with this new piece of technology. How did you effectively, from the banking perspective, obviously you grew up with the legacy systems where COBOL was the programming language at the time, but are you building it yourself, or are you relying on existing technologies or new technologies? How are you actually building up the DAG Global Bank?
We've I've got the similar experience here. The old school technologies are tried and tested, but they also cost a lot of money. And if you engage with some of the big names, you get what it says on the tin. It does scale. It delivers core banking functionality until you want to change something. And the second you want to change something, the bills just quadruple. And one innovation that's happened even since I set up the bank within the Credit Suisse group was the emergence of Fintech. And over the past 10 years, you now have systems with APIs that can speak to each other. And yes, you have to maintain those connections and make sure that they work. But you can plug and play the various systems together. And so we've come up with a model where we're largely not building much, but the connectivity and the design. And we're outsourcing then to software as a service type models for core banking, treasury, credit, all of the main systems best in breed. And my view is, if we're designing with the intention to be able to replace a key system every 3 years, we focus not on the systems, but on the data and on the services we deliver to clients. And that data ultimately is, and how we manage that data is the client experience. So we're having a different philosophy perhaps than I would have had 10 years ago in setting up a bank.
What makes you very, very nimble. But in terms of the interaction between your customers, essentially from the first phase, you're going to be B2B and then eventually B2C. And obviously it's web-based platforms. How much of the technology that you're using is going to move from, and you mentioned user experience, can move from web-based to mobile-based, where most people tend to interact with each other on that basis?
Thankfully, most of the tech is both web and mobile. particularly the front end. We're using Salesforce as our CRM and also client front end. And Salesforce is so massive that, and my CTO has a very strong Salesforce integration background. He ran a business that worked with it. And the idea is, if we can get that client experience to be multi-platform, we still see, particularly for our intended client base, which is more the SME and digital asset firms, that people want to have a human engagement, particularly if there's any issues. They don't like going to call centers where they don't have a personal connection. The whole backend will be fully digitized, but I want to have a person that there's a relationship, and this is why we're calling it digital merchant banking. We want to have that understanding of the client, because we think not only is it better for the client experience, but hopefully we'll also get more business if they think of us as people rather than just as an anonymous platform.
I mean, naturally, when you're using such a large amount of data and new technologies, artificial intelligence does play its part in managing such a vast amount of data to improve the customer experience. To what extent are you using artificial intelligence?
Extensively, actually, and this will be something, just again, about philosophy. The intention is we use AI to scrub the data. Say for credit, if an SME comes and applies on the platform and they enter in the key information that we need, behind the scenes, even concurrently as they're entering the data, you can be running a huge number of checks across credit scoring, the location at which they're accessing the platform, and cross these with your preferred approach for say said client. But at the end, I want a human being actually pressing the button, giving them access to that data, but using human experience over decades, ideally, of defaults and issues with clients where they can see through that data and make sense of it. I don't think AI can yet do that final step.
No, I mean, it's essentially an evolution of machine learning.
Yes.
To be honest, the people get scared by the word AI because they think there's going to will be end of going beyond singularity eventually one day with all these supercomputers. But Hirander, from your perspective, in terms of adopting AI and the platforms that you're building, to what extent are you using them?
If we look at that, I mean, we walk through that where ultimately the data, the inputs that you're using, and the data warehouse and the CEP system that you build have to be data agnostic. But also, as Sean said, scrubbing the data is key because ultimately, what you put in influences what you get out on the other side. And then, we've done a lot of work on the algorithmic side where we've looked at that from a market surveillance standpoint as well, and looking at kind of pattern matching and throwing out new styles of alerts vis-a-vis what exists on the basis of trading activity and learning from that and the feedback loop around it. Going forward more broadly, if we look now with the stock exchange that we've just got licensed in the Seychelles, SECDEX Group, and that whole post-trade that exists with that, there's a tokenization platform on the front end of that. And if we look at contributions into that platform, and sign up can be retail and wholesale, but fiat contributions using smart contracts, as well as non-fiat crypto, for example. And so for that, from the perspective of automated KYC AML, but not just fire and forget, but also pattern matching, and then learning from that and throwing out exceptions, we're also applying AI as well as blockchain in tandem for that side of things, so that first point of call with the customer, and this is all mobile app, iOS, Android, but also web browser based. That becomes kind of intuitive. I mean, as Sean rightly says, there comes a point when human interaction is also important as well in all of this. So whilst we do that, we also ensure that from a customer service standpoint, there is servicing there, because whether it's a consumer or whether it's a wholesale customer, they do want someone to talk to on the other side of things, but equally, for example, yesterday I got an Amazon delivery, or I was supposed to get an Amazon delivery that said was delivered and didn't arrive. Now, when I finally figured out what to do with the chatbot, you could tell the whole thing was automated and it worked quite well, and I got a refund processed. So there are areas where it works that are more commoditized, but for anything that's beyond that, it's going to be an evolution in process, but we will get there.
Thank you. Just finally, in terms of the use of technology as we know today, it crosses borders, it crosses nations. Business is becoming much more regionalized. The Belt Road that is being developed in Asia, from China all the way through to Europe. There's various clusters in terms of not necessarily national, but transnational borders, transnational communication, transnational commerce. Obviously, we've talked about regulation and the barriers of entry with regard to that. But at the end of the day, technology is enabling somebody who's based in Senegal to correspond with somebody in Mauritius and a counterparty that's based in Zurich, and fulfill some form of digital transaction and fulfill their needs, which is not available today. So in terms of the platforms available to do that, you've built these technology platforms, but what do you use for your outreach to talk to these type of customers, and what digital tools are you using to find these customers?
Yeah, I mean, what technology can fragment, technology can also knit together. And now actually, people, there are proponents of blockchain and others use it, kind of almost as a marketing hype. And there are a lot of platforms out there that talk about the fact that they're doing things or tokenizing, but we know that there's hot air and vaporware blowing through a lot of them. So, for us, it's about doing real business and making real change. And so when we talk about deploying platforms, one, yes, we have our own platforms, but we're also platform agnostic. So, for example, we have digital custodian play in multiple jurisdictions. Seychelles being one of those, ADGM in Abu Dhabi with Arabian Bourse that we're doing there being another one. But you've also got to be platform agnostic and linked to third-party custodians, because ultimately it's about giving the end user, whether they're a professional investor or whether they're a retail consumer, choice. And the more choice you give them, but the more seamless it is for them to utilize platforms, as you rightly said, whether you're in Senegal, whether you're in Seychelles, or whether you're in Abu Dhabi, that user experience should be seamless. But equally, you should have choice in the way that you transact. Of course, some jurisdictions or cross-jurisdictional activity won't work, and that's where exclusions of the technology come in, because of course you're not going to have cross-border transaction flow from the US into Iran or North Korea, for example. But that's okay, because the technology is set up to be able to handle that. So what we're doing, we're very much looking at this as two things: decentralized and centralized, because everyone's very naive. Not everyone, but a lot of people that we see in the decentralized space, because they haven't dealt with regulation, but there's a level of naivety where they think everything's going to go decentralized. But for the foreseeable future, the old world, or the current world as we call it, the traditional world, has to coexist with the new world. And we're very much going to see a hybrid construct where, for example, on the stock exchange side, we can support traditional listings, we can support digital tokenized listings, but we can also support a hybrid listing that's a combination of the two. Or equally, if you're looking at fiat banking, yes, you may be connected to Ripple from your digital custodian, but you may also have to connect, because of CSDR regulations and other things in Europe, to a central securities depository or a traditional custodian, and then back into SWIFT. So the two have to coexist, because you may have some banks on Ripple, but you've got many, many more banks on Swift as well. So I think that's what we're going to see in the near term, and that interoperability between blockchains and also between traditional finance and the fourth industrial revolution enabled finance is going to become key. And the organizations that solve that are the ones that are going to prosper, irrespective of what we see with COVID-19.
Thank you. Sean, in terms of the current crisis that we're in, I feel for a lot of us in particular, I feel a lot of sympathy with people in other countries that don't have the infrastructure that we have, the ability to communicate and talk to each other live using technology. But in terms of the digital platforms that you're building, and with the help of technologists, firms like GMEX and that Hirander was describing. But obviously this has given us a chance to look at resetting the clock effectively in terms of our evolution in digital transformation, because the economy is going to change. The world economy is going to be impacted on what's going on at this present time. We can't walk away from that. We know that's going to happen. Are we ready to adapt very quickly to the new changes, and will technology lead the way in helping us to actually get back to the new norm?
I've been amazed just how seamless it's been to transition to working from home. We were very lucky to have systems in place, and I think quite a few firms were running around getting stuff set up in the first week after lockdown, particularly. But now that it is, the only negative, and Hirander and I were discussing offline, in some ways it's more productive work because you're not distracted, but you are missing that bonhomie that you get in an office, and just that day-to-day interaction that helps to grease the wheels. And I think as we're thinking through this and how it impacts our own business, working from home has been a boon, and I think we're able to succeed in white collar financial services. This is going to hit other sectors much harder than us, and we're at a lucky stage in our trajectory as a firm, because we're going through the regulatory process, and that is largely desk based. When we go more towards a business development angle, we've been thinking through how do you engage, and as you said, how do you bring in business if you have a purely digital medium of communication? How do you access those channels? The way we've been thinking is to go with networks, and just as Hirander said, if you have connections of firms in similar areas, or you can help other firms and build relationships that way, they will open up their books, and then you can work with them to say service their clients as you can service theirs. That goes back to fintech and how the fourth industrial revolution can allow us to use open banking in my sector, or use the new regulatory frameworks that allow us to engage in certain standards and structures, and see how we can leverage those. And I think that's a story that's still unfolding. Open banking, at least yet, hasn't really delivered on its promise. But I think this current COVID-19 challenge will help certain trends accelerate.
Excellent. Thank you, Sean. Thank you, Hirander, for your great insights for this interview, which will be published shortly on citiesabc.com. And further information on your companies will be found in DAG Global and GMEX.com in terms of how else to engage with you in terms of your correspondences and posts on Twitter and other social media outlets. So I want to say thank you very much for your time. It's been very engaging and very, very interesting. Stay safe, and we look forward to speaking to you again and a follow-up to your further developments and further interviews. Thank you for your time.
Thank you, Hilton.
Thank you very much.
Thank you.